Do you want to do more than follow orders? Think outside of the box and manifest your dreams? Then you've come to the right show. Welcome to the award-winning podcast, Holding Down the Fort by U.S. VetWealth. I'm your host, Jen Amos, a Gold Star daughter, veteran spouse, and entrepreneur. For Season 9, we continue our partnership with the Rosie Network to highlight motivational stories of personal growth, financial awareness, and autonomy in our military community. We're also excited to continue showcasing our partnership with Blue Water Advisors. Now, let's get started. Hey everyone, how's it going? How's your fall season going? Mine's going great. You know why? Because the weather's great. I love fall season weather, especially because it's not in the 90s. Anything mid-70s with a slight breeze. I call that SoCal weather, but in the East Coast, it's very it's very sparse. But yes, it's that time of the year that reminds me so much of my SoCal days, Southern California, in case you've never been there. And yeah, it's been great. It's been great. I hope your fall season's been great as well. Anyway, let's go ahead and get into this episode today. This episode, like last season, the last two seasons, I am taking a break. I'm going to take a break every other episode to showcase my company, U.S. VetWealth, or, showcase our partnership with Blue Water Advisors. So for this one, I'm really excited about this one because we are showcasing my husband, founder and CEO of U.S. VetWealth, and also our life insurance case design specialist, Mike Seabolt. You haven't met him yet if you've been following the show. He's been a colleague of ours for many, many, many years, and he is really incredibly intelligent when it comes to everything life insurance. So in this episode, this is actually a replay of their live stream. I don't know if they have an official title for it, maybe War Chest Academy. But in this replay that has been edited for your listening and viewing purposes, in case you're watching on YouTube, Scott and Mike discuss alternatives to the Survivor Benefit Plan for retiring military retirees. So if you are someone that is presented with the Survivor Benefit Plan and you don't know the first thing of what to do with it, or you have an inkling where you're like, I don't know if this is fitting for my family specifically. Not saying SBP is bad. We're not saying that. We're just saying that maybe it's not for everyone. Well, you might want to listen into this episode. Scott and Mike discuss how military retirees can use private insurance products to potentially gain better value and more control over your financial future, especially for post-military life. They compare the mechanics of Survivor Benefit Plan with private industry alternatives, emphasizing flexibility, liquidity, and the potential for tax-free, because we like free, growth. Scott and Mike review illustrative scenarios. So this might be good for you to watch on YouTube, by the way. We do have a YouTube channel if you don't know by now. It'll be in the show notes. Check it out. Scott and Mike review illustrative scenarios for retirement planning using life insurance policies, highlighting cost comparisons and potential long-term benefits. Lastly, they discuss the importance of understanding numbers, planning with VA disability income, and leveraging existing assets. If you want to get in touch with us, all that information will be in the show notes. You can also check out our company website, usvetwealth.com. I really hope you get a lot out of this conversation, especially if you are seeking knowledge outside of what the government websites tell you about Survivor Benefit Plan. You're just looking to explore all your options, weigh your options. And this is the episode to just entertain the idea. With that said, please enjoy this conversation with my husband, Scott, and our colleague here at U.S. VetWealth, Mike Seabolt. Enjoy.
And good morning. Welcome back to the War Chest Academy, our War Chest workshop within the War Chest ecosystem that we're building out here at U.S. VetWealth. So I got Mike Seabolt again joining us from Phoenix, representing all the expertise in the insurance industry. And we're so lucky to have Mike here giving us the inside baseball on how these strategies work. Because if you've been following us for a while, if you've read any of our stuff, you know that the main reason people come to us initially is they're retiring out of the military and they may or may not have heard about it, but they got to make a survivor benefit plan decision. So sometimes people are getting it dropped in their lap and really don't know, how to make the decision. Or people have kind of understood it. They get it and they just don't like it. And they're Googling and saying, all right, there's got to be a better way to do this. But of course, when we're thinking about the cost versus benefit of anything, we're trying to figure out what the value is. And the misunderstanding when it comes to the military retirement pension and the survivor benefit plan versus a private industry alternative is that it's not the same tool. It's not the exact same structure of how the cash flow works. When you're funding the SBP as a pension protection tool, the way you fund SBP is they just take it right out of your military pension, comes out of your LES before you even see it. Versus on the private market, we've got to design it. You've got to own an insurance policy and you've got to fund it. Now, of course, the idea is, well, if I was going to pay for SBP and I want to do something else, well, let's just start with the kind of exact numbers. Apples to apples. Again, it's not the exact same. It's never going to be. The pension and the SBP are both streams of income annuities. There's only one scenario where you get the benefit. One, you got to retire from the military to get the pension. And then two, you got to die before your spouse for anybody to get the SBP, regardless of how long or how much you've paid into the SBP. But on the private marketplace, you can design it however you want. Just depends if you qualify. And assuming you've got funding to make sure it works. So now you're in more control. But of course, you've got to be in control of it. But we'll show you how we can set that up so you don't have to freak out and manage it and act like you're checking your stock portfolio. No, life insurance doesn't work like that way. We can set it up as a program that you can manage as you need to, just like you'd buy a house. Planning on living in it, but maybe you got to find other ways to profit from it. Maybe you sell it down the road. Maybe you rent it out to somebody. There's flexibility for you. Maybe you take an equity loan. And, that's what ownership gives you versus renting. So the big question then, of course, is how do the numbers play out? And so that's what we want to start with today is just show you exactly how we get the numbers, how we do this with everybody, how you can do this at home to make these decisions. Now, I will say I write this all in the book. Don't forget your war chest. It's over there. You can get it on our website absolutely free. Actually, I'll show you where to do that before we get into the calculators. Still updating the website, but I just made a major change on the back end, which is going to allow me to... Am I sharing? Oh, there we go. Cool. So up here at free resources, you can get access to our books. Go ahead and download these. We've got two different books right now, one about the TSP and one about the SBP decision. And what we outline here is the case studies. And so for today, we're talking about SBP. And first things first, I'm assuming you've all been to the military retirement calculator to see how much you're going to get for your years of service. And in this scenario, we're talking about an 06, Colonel, Navy Captain, 06 with about 30 years of service. What are they going to get? And of course, this is a really good looking page, $130,000 a year, plus or minus, every situation is going to be slightly different, but that's a really good income. But key numbers we want to look at are the present value right here. And of course, total retirement. If you lived a life expectancy, how much benefit are you going to receive? And so, that's these are the values somewhere in here, just depending on how you want to value it. But essentially, you'd have to have $3 million in the bank today to really be able to pull out $6 million during life expectancy, assuming interest and stuff. So that's how valuable this asset is. So that's why SBP is valuable. There is a protection mechanism built in, but it's the exact same for everyone. Exact same cost, essentially 6.5%. No matter how long you live, no matter how healthy you are, male, female, doesn't matter, 6.5%. So if you survive, now you only have to pay for 30 years. So whatever 30 years here, 1950, well, yeah, that's about 30 years. So basically 6.5% of these numbers would get cut off the top. And the only way you get any money back is you have to predecease your spouse. The plan is there's only a benefit if there's a survivor. So the retiree, the children don't have any recourse, essentially. So this is where we're getting our numbers. On the death benefit protection side, you can protect as much of the pension you want as you want. SBP is only going to protect half of this. So about $1.5 million equivalent, but you don't get it that way, once the demise does happen. So if you want to protect more, to give you some sort of ballpark range, when you're thinking about, all right, instead of doing the backwards method of, all right, what's my college kids cost going to be and the mortgage payments and all that, let's just protect the whole pension or closer to the full amount. If you're healthy and can qualify for it, it's a great deal for you. But if you do download the book, I give you access. I send you a bunch of emails with some tips on how to, analyze this a little more. And one of those emails, I give you access to this calculator. And this is where you can put in your birth dates and get the probability numbers. I talk about that in other videos. But you can also just put in right here real quick and see what the full costs are going to be of the SBP. So we put in roughly that $130,000. So that's a $700 a month SBP payment. So when I turn it over to Mike here in a minute, that's going to be scenario A. If we're looking to just replace SBP, the easy way to do it, of course, is just go online and try to find something cheaper than $700. And the only way to do that is with term insurance. Nothing wrong with term insurance. And we do that too. That's a great way to cheaply lock in some of that large death benefit we're trying to get. But what we're going to show you here is a permanent solution. Term insurance is term. It's temporary. It's only going to last for the length of the term. That's why the cost is so low. Likely you won't use it. But we want to get you a return on investment regardless of the scenario. So if you're going to be dropping $8K a year into something, what if after 10, 20, 30 years, you could turn around and access that accumulated value while also maintaining that rather large death benefit without any of this having to feel like it's a budget item after you retire out of the military, right? There's lots of ways to structure it. And so that's what we're going to do today. We're going to look at if we did an apples to apples comparison. Again, we're not going to just do the cheaper option. That's easy. We can just go on and do a quick quote. Hey, if you're healthy, it's cheaper. Yay. What we're going to do is show you how to create that account and that return on investment. And we're going to give you two different scenarios because it's the same amount of dollars going in over 30 years. So if we mimic the SBP, we pay every month for 30 years, kind of like a mortgage payment. But if we treat it like an asset and we take advantage of time value money and the fact that in this scenario, individuals 50 years old, most people tell us they only want to work a good 10 years more. So what if we took those same dollars, again, what's $8,000 a year going in for 30 years? I got it right up here. That's, well over $300,000. This has an inflation adjustment in it. I'm going to take that out just for now. Should drop. Oh, I think I have a link. Anyways, between $250,000 and $370,000, just depending on whether or not you're adding inflation in it or COLA. And so again, those are ballpark numbers when we're thinking about how much money could have been lost for SBP versus can we redirect that into something we can control and tap into? So that's the big picture. And again, download the book, go to, our website. I think I got the link below here. Don't forget your war chest, get access to the calculator, run your own numbers, and then hit us up for a call. You can schedule a call on the website, hit me up on LinkedIn, and happy to chat and run through these numbers with you. But yeah, those are our numbers. That's our scenarios. And Mike's going to run us through looking at an insurance illustration because this is the other learning curve here. It's like, now I got to understand how life insurance works. Wasn't expecting to do that when I was retiring out of the military, right? And so Mike makes it easy for us.
Yeah, no, perfect, Scott. Thank you. And Scott, you hit the nail on the head, really. It's about choices. It's about options. It's about what's right for you and your family. Do you want to leave $700 a month for the next 30 years with the government, $250,000, $275,000? Or would you rather put those dollars into something that's growing equity for you? And on the backside of that, again, the story we share, and I've shared many times, is, option A, SBP, your spouse, again, if she does live beyond you, God forbid she dies earlier and you don't get anything, but if she lives beyond you for whatever many years, 3 years, 5 years, 7, whatever it is, she gets 55% of your pension income as taxable income to her. And so can we be more efficient? In lieu of 55% of your pension income, what if we just give your surviving spouse $1 million tax-free lump sum? That's kind of the story, right? So those are two ways to go. And then more importantly, while you're alive, before you die, that $700 a month, that $250,000 or whatever it is, will over 30 years create significant cash value, creates equity, creates liquidity. It creates another vehicle that you can utilize that doesn't exist if you leave the money at the government. That's $700 with leaving with the government. What do you think you're going to get out of that? There's no equity being built. The only benefit is you die early. That doesn't sound very good. So that's what we do. We really try to educate, empower. These are important decisions. We appreciate that. And our job is, again, just to look at both options. So I'll share a couple of things with you guys. I think that'll be helpful for us to kind of step through here. Perfect. All right. So I'm just going to go through this quick. Can you see my screen, Scott?
Yes, sir.
Perfect. So this is one of our carrier relationships that we utilize quite frequently. Some of you on this call with us today and on this meeting may be familiar with this, may own this product. Nationwide Financial is the insurance company, one of the top in the industry. Nationwide is on your side, as the commercial says. The reason we like this particular carrier and this particular product, twofold: low cost, some of the lowest internal policy cost in the industry, and coupled with unlimited upside or growth potential. So the IUL, in a very high level, kind of the bullet points to take away. The first one is the money is tax-free forever. The money grows tax-free, the money distributes tax-free. So we're talking about the cash value. Never taxed again, no 59.5 early withdrawal penalties, no 72.5 required minimum distributions, liquid at your discretion, no taxes, no penalties. The second kind of bullet point is the dollars we save and invest, and I use that term intentionally, not pay a premium, not what's the cost, what's the expense, but hey, we're going to save and invest that $700 a month, for example, for that SBP replacement into a vehicle that grows based on the global financial markets. So the growth is based on stocks, bonds, commodities, US, Europe, Asia. So multiple asset classes, multiple jurisdictions, no downside. So as many of you may know, there's a 0% floor rate. So what does that mean? Bar goes up, we get most of the upside. In a down year, we have a zero. So it's a safe money story, what makes us feel super comfortable. And then the third kind of bullet point, as I touched on earlier, is liquidity. Accessing the cash while you're alive as an equity feature. And then, of course, it is life insurance with death benefit. And then that death benefit also provides long-term care protection. So baked into the story is while you're alive, if you need help, which the math says 7 out of 10 of us need help in the future. If you do need help, you have the option to accelerate the death benefit of the life insurance while you're alive for care. Tax-free, dollar for dollar. If you never need it, you don't have to use it. Goes to your family, but we know that risk is also protected here. So it's kind of like a Swiss Army knife. Provides a number of different features and benefits, and that's really what we love about it. So this is the contract. I'm just going to kind of jump through this really quickly and then jump down to the numbers. Of course, Nationwide's been on your side for 100 years and A-rated and all that other stuff. Why are we talking about this? Protection is life insurance. Growth potential, we talked about that a little bit based on indexed credits. The dollars grow based on the global markets. Flexible premiums. This is massive. So what we'll talk a little bit about is the option, the flexibility to save and invest more or less annually at your discretion. So we talk about that monthly cost, that $700 that you would be spending, leaving with the government with SBP. That's a good starting point. But then we're going to look at, hey, what if I did look at this as an investment? I've got all this income coming in. I have VAD dollars and VA disability dollars that I may not need for my living expenses. I have that second job, making 130, 140 there on top of my pension, on top of my VAs. So I've got to deploy that capital somewhere because I need it to grow for me and protect my family. The flexibility to put more money into this, swing at your discretion. And that's a little bit of an interesting concept because most people think about life insurance as a cost, as an expense. What do I have to pay? How much do I have to write a check for? And that's really term insurance, right? You pay as little as you have to get as much as you can. With this type of insurance, we want to think about it as an asset class, as an investment, as something that grows value over time, that has zero downside risk and all the other things we talked about. So the flexibility is key. Guarantees, guaranteed floor rate, guaranteed death benefit, cash for later. We talked about that, using the liquidity, using the equity built up in this policy from a liquidity perspective. And then the last thing, probably the first thing we should have talked about, tax advantages. And I think that might be the most impactful. So I'm just going to jump down to the numbers for us here just to give you an idea. So here we go. We've got an 06, it's a Colonel 06, 60 years old, healthy when he's getting out. And basically, we're looking at $700 a month. We're looking at the cost that we would have left with the government from an SBP perspective. And in lieu of leaving the government, we're going to take that money and put it here. So $740 monthly is $8,400 annualized. This policy starts out at $250,000 death benefit. The surrender value, if you can see my screen, is the cash value that's liquid to you. This is the cash that grows over time. So again, this is your equity component. So this first example, we are assuming we are paying the $700 a month for 30 years, the same amount of time we would have left this $252,000 with the government. That money would not come to us. And so in lieu of doing that, we're going to take it and put it in our pocket, buy life insurance, and then the surrender value at the end of that 30 years is about $500,000. So basically about twice as much from a liquidity. So thinking about, again, government's perspective, there's no equity at all. The only benefit is you die. That your wife gets some money or your spouse gets some money afterwards. With this example, while you're alive, we have $500,000 in cash. You can just take that and walk away. And that's not an option with the SPP. So this is kind of the idea for this individual, and it gets grows, and then the death benefit starts growing a little bit. We were at $700,000. We get closer to life expectancy. Couple of things about this. The first thing is we're assuming about a 6% return in this contract. It's actually average closer to 10% a year. And I'll just quickly show that here. So here's kind of what is done historically on this. And so you'll see this historical average on the right-hand side of my screen basically shows what this has done, again, from a historical perspective. And you'll notice it's better than 10% a year, while the assumed is 6. So what I'm getting at there is these numbers are based on 6.17. If it does 7 or 8 or 10 or 13 or whatever, obviously the numbers look a lot better. But on a very conservative basis, we basically double the money that we would have left with the government. We could put it in our pocket and provide a death benefit for our family. So this is, again, what we say, direct qualifying costs, the exact money we would have left with the government. Then we say, hey, what if we expedite this funding process? What if we put this $250 in, but did it more quickly? So what if we put those same dollars in over a 10-year period, not a 30-year period? Let me see if I can find the right one here. Here we go. So say all the stuff here is the same. The difference being is we put that $250,000, a couple bucks less, roughly the same, in over 10 years. Now, after 10 years, we're done. There's no more funding going in. And you'll notice that surrender value is already cash flow positive. Our cash, after 10 years, we've already got more cash than we started out with from life insurance. Death benefits also higher. And then I'm going to move forward just to that year 30 again. So apples to apples, year 30, we put the same $250,000 in, but now we have closer to $1 million in the policy. So the objective is, the impetus is to overfund this thing at your discretion when cash flow makes sense. But what we talk about is that, as Scott mentioned, that 10-year window. And maybe in that 10-year window, we look at repositioning assets to fund this over that 10 years and done. And then let it roll forward from there. So things like VA disability dollars, very common. A lot of our clients, veteran clients, come to us and say, hey, Mike, I've got 35, 40 grand coming in, VA disability. Can we use some of that to do this? I don't really need that for my income. And over 10 years, and then we're done funding this thing. So again, the idea is on a very high level. It's very individualized based on your specific situation. Flexibility to save and invest is more or less as we choose. So this first one here, this $253, that's a monthly, call it $3,000 a year. That's a no lapse guarantee premium. That's kind of our baseline. That's the minimum we put in. So $3,000, if the wheels come off the bus, $3,000 keeps us protected. And then we have the ability to fund up to $25,000. So $3,000 on the low end, $25,000 on the high end, which is our plan premium with this design. At $25,000 a year, this policy is fully funded in 10 years. And again, just looking at those numbers once again, close to $1 million, and then down at life expectancy, well over $1 million in the policy. So again, the message we said to begin with is, in lieu of hoping your spouse capturing 55% of your pension after you die and hoping we get money back, and how long we have to wait for $250,000 to come back to her, in lieu of that, what if we just give $1 million, lump sum, tax-free, do whatever you want to with it? Well, that's kind of the idea.
Mike, could you scroll back up to the first 10 years again?
Yeah.
Because, you hit on a good point. When it comes to funding, I think we see, let's say, 3 scenarios. It's 3. If people are looking to really max fund this and they're like, all right, how can I do this? A couple ways to think about it. Mike hit on the VA disability. If you're earning VA disability and you don't need it, that's tax-free dollars. And then any money that goes inside of insurance policy can grow tax deferred and can be access tax advantaged, if we do it right. So you never have to pay taxes on those dollars on the growth. So that's a nice funding mechanism as well. Oftentimes, people just have an extra cash in a savings account, or maybe they made a recent real estate sale, and obviously now is not the right time to get right back into an easy purchase for a new real estate. Maybe there's a good place to kind of hold those dollars for a while also, funding this process while you're waiting for the new job and income to come in, because that's the other option. And Mike Wallace tells us from Blue Water, guys are going through doing their salary negotiation, know what they can negotiate. And those are pretty high numbers. I just talked to somebody today, opening salary, $180,000 on top of their retirement pension. But what often happens is, Mike tells me this, it isn't until month, 3 or 4 of them in that new job that they're looking back at their bank account and saying, holy cow, this is adding up. And if, of course, people say, hey, I want to save aggressively in these next 10 years so that I can be done at age 60, then actually this one's starting at age 60 here, Mike. So if he was 50,
the 60-year-old,
that would be even better.
Yeah.
So keep that in mind. We'll do the 50-year-old next week to see what those numbers look like. But again, the math is the same. The younger you are, the earlier you start, the bigger the numbers grow. That 18 a year one, was he 50?
This is the one. This is another one. So this is a younger guy. This is a 50-year-old getting out, still in 06. And the cost of the pension there, the cost of S&P is $500 a month. That's $6,000 a year. So this is a slightly younger guy here. And then this, again, same math here. So, here we are down the road after 30 years, we put 180 in, again, roughly twice as much in cash value. And then we also looked at the same example here of doing that same 180 over 10 years instead of 30. And again, what does that get us to? There's the 180 grand over, and we have, almost $750,000 in there. And then again, life expectancy, early 90s, $1.3 million, $1.5 million. So again, the idea with this is the flexibility to save and invest at your discretion. Starting earlier and saving more, like everything else, makes a lot more sense. But what's nice is we don't have that, we don't have a call it a rope hanging on our neck. We got to write this giant check every single month for the rest of our life. This doesn't work that way. Here's the deal for a 50-year-old. The minimum is only $149. The no lapse guarantee premium protects that $250,000, and then as much as 20. So again, flexibility.
And I think that a lot of the misconception when permanent insurance is talked about, term, you got to pay monthly. And actually, if you could go back to the first 10 years again, talk about term real quick.
Right here.
Here's where we use term. So if you look at the death benefit, we're only purchasing a $250,000 death benefit initially on the permanent policy to keep costs down. Any additional death benefit, that's where we use that cheap term insurance. Yeah. But now we can manage it. Should you want more permanent insurance, you're already approved with the term. We can convert it over to the permanent. So that's nice. But for those who already have life insurance, we'll take a look at it. You don't need to replace stuff that you already got a great deal on. But as Mike was talking about, having a lot of times you're thinking of insurance, I got a monthly payment every month. And that happens with a whole life policy, typically. Or if you've had a whole life policy, that's most likely what you've been used to doing. Again, not right or wrong. It's just that's the structure of it. Yeah, it's not as flexible. But other good news is you can replace that whole life policy and use it to help initially fund this policy. And that's just called an exchange. It's 1035 exchange. It's just a tax-free transfer of insurance cash values. And it's a nice way to stop having to pay that kind of mortgage payment whole life policy and also jumpstart this whole program, allowing you to potentially, if you're in between jobs, to not have to worry about funding this for a while at all. So you can use tools you already have available, assets you already have. And so lots of flexibility. You probably have a lot going for you. Even if you think you might not be healthy to qualify, maybe you tried to qualify recently and got denied. We've got unique relationships with these underwriters. They've been flexible. They're not going to break any rules, but they've been more understanding. They don't see, there's a lot of Americans, not a lot of them are retiring out of the military. So believe it or not, you are a very rare situation. And unfortunately, your medical records have been kind of intentionally made to just qualify you to get deployed or to sort of make you look sick on paper so you can get better VA disability benefits. That can slightly backfire when it comes to if we don't manage those medical records or understand them and translate that to the underwriters, you might miss opportunities. And so we help do that. We help translate, get them to understand your situation, especially if you're overseas. Life insurance is a stateside thing. You got to do it stateside. So we'll work with you no matter what your situation is. Even if your timeline's coming up, you've got options that you might not be aware of. It's worth a conversation. We're happy to have it with you. So hit me up, Scott Tucker on LinkedIn, and visit our website, usvetwealth.com. Download the book or schedule a call with me anytime, and we're happy to answer your questions. But that is all for now. We'll see you next week. We will look at, we did look at the 05 thing a little bit. We'll look at that in more detail in the future, look at a younger scenario. But next week, we'll look at it's called sequence of returns risk. Right now, people are concerned about their largest asset, retirement dollars, is usually in a TSP account, or that a combination of like a Roth IRA. And that could be $500,000 or more. And it's the largest asset. And if we're going to have stock market fluctuations, especially when you're thinking about using the dollars, that can have a negative impact. So we're going to show you the risk there, how that works, and then what to do about it using a fixed index annuity. And that's what our other book's about, the TSP to FIA rollup. But we will call it there for now and see you next week.
All right. Thanks, Scott.
Thanks for joining.
Hey there, this is your host, Jen Amos. Thanks again for listening to today's episode of Holding Down the Fort by US VetWealth. Visit holdingdownthefortpodcast.com to access the full show notes of this episode, including resources mentioned and bonus content. Once again, the website is holdingdownthefortpodcast.com. Lastly, stay after the outro for a little something extra. Thanks again, and chat soon. Bye for now. All right. Hey, everyone. Thanks for joining us in the outro here. It always fills my heart knowing that people actually care about what I have to say. Just so you know, I'm not speaking from a low self-esteem standpoint, and I'm not trying to fish for compliments here. I'm just grateful. I'm grateful when people stick around, when you want to hang around in the outro and you're like, oh, I kind of miss Jen in this recording. She wasn't in it. It was just her husband and, Mike Seabolt, and I want to hear Jen. So thank you for wanting to hear what I have to say. So if you are interested in learning more about the alternatives to Survivor Benefit Plan, I want to share that our company, US VetWealth, offers a complimentary strategy session, no cost to you. You just have to go to our website, usvetwealth.com, and fill it out. And you'll likely be talking with Scott or someone on our team for 15, 30 minutes, depending on how many questions you have. And that's it. We just hope that in having that complimentary strategy session, you walk away informed and educated and confident in whatever decision you want to make with the Survivor Benefit Plan and your military benefits for that matter. Also, the cool thing is that maybe you're not ready to fill out that complimentary. Maybe you're not ready to talk to us yet, and that's totally fine. We have an online portal. Actually, Holding Down the Fort, Inside the Fort private podcast is housed in US VetWealth's online portal. And all you have to do to get access to it is go to militaryretirementblueprint.com. Now, you can also, go through the back door with my link, holdingdownthefortpodcast.com/portal. But the other link is militaryretirementblueprint.com. So either way, we'll take you into our free online portal. And from there, again, if you are looking to just stay informed and read things in your leisurely time, our online portal, our free online portal that you can jump off of whenever you want, has a wealth of knowledge, free resources in just educating you on everything Survivor Benefit Plan, Thrift Savings Plan, and any other questions you may have about your military benefits, especially when it comes to financial planning for post-military life. So if that's for you, once again, you could either go through the back door through my portal link, which is holdingdownthefortpodcast.com/portal, or you can go to militaryretirementblueprint.com. Both of them have different storefronts, so to speak. And so you can kind of see from different angles, what US VetWealth has to say about the portal versus what I have to say about the portal. But if you go through my my link, I have no financial incentive, by the way, by promoting my link, just so you know. It's not like an affiliate link or anything. But if you go through mine, you will have access to my private podcast, Inside the Fort, which is also free. We love to give away a lot of free stuff because we know that we believe that like knowledge is empowerment, like it's self-empowerment. And we want to provide education that isn't as accessible or isn't even offered in government websites. We like to give an alternative perspective so that you can make well-informed decisions. All right. Well, anyway, I hope you check that out. Like I said, you can go to holdingdownthefort.podcast.com/portal, or if you want to go through the US VetWealth storefront to join our free portal, visit militaryretirementblueprint.com. All right. Thanks for listening, and we'll chat with you next week. Bye for now.